Happy Friday, Eric Bible with the Bible team at Neil Home Loans, and another week, and unfortunately, another rise in mortgage interest rates. As we kick off this Friday, the 30-year fixed is at 6.21, which is up from last week's 6.17. And if you're like me, you're likely getting the same questions. Eric, the Fed cut. This is what we've been waiting for. Shouldn't rates be lower? And yes, we've covered this on weeks past, but the phone calls still keep coming. And yes, we continue to see mortgage rates rise really day over day. Yes, they're small incremental increases, but they're rising nonetheless. And those phone calls and questions are still coming in. So my goal here is to continue to empower and provide valuable information of which you can be that sounding board and beacon of light to your clients in these very uncertain times. So let's dive in. Let's understand ultimately, what is driving this market psyche, what we see and expect short term and ultimately long term. So as we know, Fed cut for the first time on September 17th since COVID 2020. Wildly anticipated, eagerly anticipated, as we saw at the beginning of the hiking cycle back in 2023. And the expectation walking into this first cut was this was going to shepherd us into lower rates. And unfortunately, it's doing the opposite. So we have to understand why. So ultimately, it's not the cut that the market is reacting to. It's the comments specifically from Jerome Powell in the Federal Reserve. As we know at the onset of this previous monetary cycle, raising interest rates on behalf of the Fed, it was all in the name of curbing inflation. Well, over the last few months, really few weeks, that focus on behalf of the Federal Reserve has shifted from inflation. Yes, it's still important, but their primary focus now is on rebalance and stabilizing the labor force. So, what this means and why is it important and why are we seeing mortgage rates respond in this manner? Well, if we go back to the comments of Jerome Powell, he was very quick to point out where, yes, inflation is important. Our primary focus now is stabilizing the labor force. So, what that has ultimately told the market is, hey, the Fed is willing to potentially even see inflation rise if it means controlling the rot within the labor market. Why is that important? Why then are we seeing mortgage rates higher? So, as we know, mortgage interest rates and inflation do not see eye to eye. They're very fond enemies, if you want to call it. As inflation, as the cost of goods rise over time, deterioration of dollar value, if you're holding a fixed payment asset for a long duration of time and the value of money declines, that your returns decline. So here in the short term, we've seen the yield, the return on 10-year treasuries actually rise post-Fed decision. Historically, the 10-year treasury has been really a guiding beacon, if you want to call it, for what mortgage rates do. So with that inside the psyche of the markets as a whole, taking that information on behalf of the Federal Reserve with the expectation that, hey, the Fed is willing to potentially tolerate a rise in inflation short term, potentially long term, we're going to see that return or yield on the 10-year rise, which ultimately correlate to rising mortgage rates. So here, the silver lining in all of this, as we've witnessed in hiking cycles past, where immediately following the Fed rate hike, yields, stocks, 10 years, all of that continue to rise. As reality sets in, and as we start to see additional deterioration within the labor market, rates start to come down. So yes, I still do, as does the market, anticipate that we will see more favorable rates and a decline in rates over the coming months, weeks, years. At this very moment, yes, interest rates have gone higher. So I know your clients are asking us the same question. So does this still mean now is an optimal time to enter market? And the answer is yes. And here it's within a state of fear, opportunity presents itself. The individuals that took action when rates were at their peak, they're now harvesting savings through refinance. And yes, their home values have appreciated through that. I look at this moment in time very similar to other snippets in time. Everyone is saying, no, it's not good. No, it's not good. Well, let's future cast that 12 months from now when their home value is increased, interest rates are lower. They have beat the herd. There is no competition. They're now refinancing into a more favorable product. So yes, it's not ideal that interest rates have risen over the last few weeks. They're still lower than they have been for really the duration of 2024 and a better part of 2023. So yes, it still doesn't feel like what we all wanted or anticipated. There's still favorable options there. So I implore you to take this information to your clients, be that value point of reference to where they can call on you to help guide them through these uncertain times. As always, we're here, we're available to help communicate this, help break it down and distill it to digestible components for your clients. As always, make it a fantastic Friday and an even greater weekend.